The fact that all 23 of the biggest banks in the U.S. passed the stress test with flying colors, and the regulators have authorized stock buybacks, is that a strong signal that all systems are go for the U.S. banks?
Well, first of all, thanks for having me, Kim. Great to be here as always. Big win for the U.S. banks. As you noted, all of the largest U.S. financial institutions passed this year's Fed stress test with flying colors. Really important milestone because, as you noted, it unlocks billions of dollars of buybacks and dividends. Previously, the Fed had put in place restrictions on capital returns during the pandemic. Due to the stress test results, those restrictions have now been lifted. And as of July 1st, the large U.S. banks are free to buy back stock, pay out dividends in much larger quantities than before. I'd say big picture, very positive for the sector. The regulators have basically written a clean bill of health for the U.S. banks. I think it really reiterates the point that these banks are safe, they're sound, they're strong, well-capitalized, resilient. More broadly as well, I think it's a signal that the regulators view the COVID pandemic, the worst of it, as in the rearview mirror. And also, we're firmly in recovery mode now in the U.S., all systems that go in terms of the economic rebound.
That's some nice news to hear. And you know, you went through a list of what you think is actually showing. When you look at the big 6 banks in the U.S., any key standouts in terms of the messaging or what's been coming out?
Well, I mean, let's put some numbers into context. You look at the big 6 banks, all of them, like I said, passed the Fed stress test. In fact, last week, 5 of those 6 actually raised their dividends meaningfully, on average up about 50%. 2 really big standouts. The first one is Morgan Stanley. They had very good performance on the stress test, saw their capital requirements actually decline. And so they felt comfortable increasing their dividend by 100%. They've also had very strong performance in their underlying business in capital markets and wealth management. And so I think all of that really points to their ability to raise their dividend. They also actually upsize their buyback program. On the other side of the coin, we have Citibank. Citibank actually saw their capital requirements increase due to the Fed stress test. So they weren't comfortable increasing their dividend. They kept their dividend flat. So definitely some winners, some losers in this round of the cycle.
I guess that's, you know, the big question is just how much of this is priced in. I mean, you talked about, you know, a couple banks, you know, big dividend increases, some starting buybacks. But, you know, is there more to come, and how much more material would it be?
Well, I guess the one thing I haven't mentioned is buybacks. Yeah, you mentioned it just now. Quite material for the sector. In fact, if you looked at those big 6 banks that I mentioned earlier, if you looked at their excess capital today, they have the capacity to buy back up to 10% of their shares outstanding. Not to say that they will do the full thing, even if they bought back 6, 7, 8%. You layer on top of that some loan growth in 2022, possibly some rate hikes in 2023 or even next year. That's pretty material in terms of earnings growth. It's really going to supercharge the U.S. banks' EPS, and I think will be supportive for share prices looking ahead.
Which banks are you watching to really being able to leverage the U.S. recovery beyond all the dividends and share buybacks?
One name to watch, one name that I'm certainly watching is Bank of America. I feel like they're a very good barometer for the U.S. recovery for a few reasons. Firstly, they do have a sizable consumer franchise, and so they're a big lender in credit cards, in auto loans, and you think about the U.S. recovery, consumers are going to be out there spending more on travel, on entertainment, on durable goods, and that's really going to benefit their top line. Bank of America also is the most rate-sensitive bank out of the large cap banks. And in fact, a 100 basis points parallel shift in the yield curve would result in 30% uplift to their earnings in one fell swoop. So definitely a name to watch, and one that I am watching over the next 12 months.
And we'll have to see, of course, what the Fed does to make that happen. But yeah, that's a big multiplier effect. What are you seeing? What would you think about the Canadian banks? I mean, the Canadian regulator, is not lifting restrictions at the same timeline as the U.S. regulators. So what are you watching there?
I mean, as you noted, right now, the Canadian banks are not able to raise their dividend, not able to buy back stock. That's a restriction that's been in place since 2020 in the midst of the pandemic, and OSFI has not yet relaxed it. I think it's very likely, however, we'll see that restriction come off or loosened sometime in the next few months. I'm looking at the pace of vaccinations in Canada, the pace of reopenings. Also, just expectations for a strong economic recovery in the back half of the year. And I think, it'd be hard pressed to see a situation where some of those restrictions don't relax. In all fairness, OSFI's been pretty quiet in terms of their intentions. A few reasons for that. We do have a new superintendent who took office just last week, Peter Rutledge. And so I think he'll want to settle in for a few weeks, a few months before making that decision. I think more generally, the Canadian regulator is a lot more conservative in its approach, much more conservative in making decisions like this. So I think they'll want to see the Canadian banks firmly in recovery before relaxing the restrictions on dividend buybacks.
Which I would think would be consistent with history, just given the conservative nature of the financial sector. I've only got about a minute here, Monica, but I mean, what do you expect to see from Canadian banks when they do get the green light to move ahead with dividends or share buybacks or be able to release some of that capital?
Mm-hmm. It's very material, something that could be very big for the sector. In fact, when you look at excess capital positions today versus regulatory minimums, in aggregate, the big six hold about $50 billion of excess capital, about 8% of their market cap. So I think they'd look to deploy it in three ways. Firstly, they'd probably hike their dividend, look to deploy some of that into buybacks, and also invest in their business, both organically and inorganically. We know a number of banks like TD, BMO, looking to do acquisitions in the U.S.
Banks have had a pretty big run. I'm going to squeeze in this last question year to date. Do you see them more upside from a valuation perspective?
In terms of valuation, Canadian U.S. banks trading 11 to 12 times. That's certainly not demanding by any stretch. Certainly when you compare it to the rest of the market, I think they're paying an attractive dividend. More importantly, they have a very strong earnings growth story for many of the reasons that we talked about earlier today. And so we remain very bullish, very constructive on the bank sector, both in Canada and the U.S.
Monica, always great to have you with us. Thanks so much.
Thanks for having me.